Imagine you wake up one morning and discover that your entire financial life, your mortgage, your salary, your retirement account, even the cash in your wallet, is controlled by a system you never voted for. A system designed in secret, by bankers, for bankers. Now imagine that meeting happened over a century ago, and you're still living under its rules. November 1910. A private rail car slips out of New York under cover of darkness. On board, 6 men using only first names. Destination, Jekyll Island, Georgia, one of the most exclusive clubs in America. For 9 days they work in absolute secrecy. No reporters, no public record, no democracy. 3 years later, the Federal Reserve Act passes Congress. The newspapers call it financial reform, protection against the bank panics that had devastated ordinary Americans. Congress celebrates it as a government solution to Wall Street greed. But here's what they didn't tell you. The bill was written on Jekyll Island, by the very bankers it was supposed to regulate, and what they created wasn't a government institution. It was a privately owned money printing machine with your name on the bill, one secret meeting, 6 men, a century of consequences. This is the story of how America was quietly enslaved before the Federal Reserve even existed. October 1907. The New York Stock Exchange hemorrhages 50% of its value in 3 weeks. Bank runs sweep the nation like wildfire. Unemployment triples from 3% to 8%. Industrial production collapses by 16%. The entire American financial system teeters on the edge of total collapse. Families line up outside banks, desperate to withdraw their savings before the doors close forever. Corporations that had been expanding just months earlier now face bankruptcy. The economy is in free fall, and there's no government institution with the power or resources to stop it. Then one man steps in. John Pierpont Morgan. America's most powerful banker personally orchestrates the rescue. He locks rival bankers in his library at his Manhattan mansion, refusing to let them leave until they pledge millions to stop the bleeding. He pumps his own money into failing institutions. He organizes a consortium to stabilize the stock market. The newspapers hail him as the savior of the American economy, the man who stood between civilization and financial chaos. Congress breathes a sigh of relief. The crisis proves what the experts had been saying. The system needs a lender of last resort, a central authority to prevent future panics. Without Morgan, they argue, the entire nation would have descended into economic apocalypse. But here's what the grateful public didn't know. Morgan's personal fortune at the time was $80 million, roughly $1.9 billion in today's money. Impressive, certainly, but nowhere near enough to save the entire banking system of the United States. The numbers don't work. You can't rescue an economy with a personal checkbook, no matter how wealthy you are. So how did he actually do it? The Pujo Committee investigation of 1912 revealed the answer. Through 341 interlocking directorships across 112 corporations, Morgan and his partners controlled $22.245 billion in assets. That's not a typo. $22 billion when the entire US economy was worth roughly $184 billion. Morgan controlled nearly 1/4 of America's entire wealth through a web of corporate board seats and strategic investments. He didn't save the system out of patriotism or civic duty. He controlled enough of it that its collapse would have destroyed his empire. And the panic itself? It wasn't random economic chaos. It started when speculators Augustus Heinze and Charles Morse, both with deep ties to Wall Street trust companies, attempted to corner the copper market and failed spectacularly. Their collapse triggered a chain reaction through the trust companies they controlled, exposing how interconnected and fragile the system had become. The panic revealed a truth the banking elite couldn't ignore. An economy this large, centralized into so few hands, needed a mechanism to ensure those hands never had to open again. 3 years later, in November 1910, Senator Nelson Aldrich slipped out of New York on a private rail car, accompanied by 5 men using only first names. Their destination, Jekyll Island, Georgia. One of the most exclusive clubs in America, where members included the Morgans, Rockefellers, and Vanderbilts. For 9 days they worked in absolute secrecy. What they created would reshape American finance forever. But first, they had to make sure no one knew they were the ones who'd written it. 6 men. Let me tell you exactly who they were and why they mattered. Nelson Aldrich, Republican Senate leader and chairman of the National Monetary Commission. He was the political shield, the man who could introduce legislation without immediate suspicion. He was also John D. Rockefeller Jr.'s father-in-law, connecting him directly to America's oil empire. A. Piatt Andrew, Assistant Secretary of the Treasury, the government insider who could navigate federal bureaucracy and ensure the plan would pass legal scrutiny. Henry Davison, senior partner at J.P. Morgan and Company, Morgan's right hand there to protect the House of Morgan's interests. Arthur Shelton, Aldrich's private secretary, handling documentation and administration. Frank Vanderlip, president of National City Bank, now known as Citibank, connected to the Rockefellers and controlling vast retail banking deposits, and Paul Warburg, partner at Kuhn, Loeb and Company, expert on European central banking. He was the technical architect, the man who understood how the Bank of England and the Reichsbank actually functioned. They travelled under first names only. Railway staff were told nothing about the passengers or the destination. The guy's was a duck hunting trip. One attendee even carried a borrowed shotgun for authenticity, though none of them had any intention of hunting. The Jekyll Island Club had been described by Munsey's magazine in 1904 as the richest, the most exclusive, the most inaccessible club in the world. It was the perfect cover. These men controlled the economic fate of millions, yet their meeting wouldn't be publicly acknowledged until 1930, 17 years after the Federal Reserve Act became law. The economic problem they claimed to solve was straightforward. The US banking system was inelastic. Currency supply was tied rigidly to gold reserves and specific government bonds. During crises, there was no way to quickly expand credit to stop bank runs or stabilize markets. The Panic of 1907 had revealed this vulnerability brutally. Corporate investment fell 50% for firms connected to failed trust companies. Average interest costs for affected firms rose 8.3%. Dividend rates plummeted 22%. The system, they argued, needed flexibility. It needed elasticity. It needed a lender of last resort. But the solution they actually created was something entirely different. Instead of one central bank, which Americans had rejected twice before in 1811 and 1836, they proposed a network of regional Federal Reserve banks, 12 of them, scattered across the nation. This was architectural misdirection. On paper, it looked decentralized, democratic even. But all 12 would be controlled by a board of governors in Washington, overseen by a Federal Reserve Board in New York. The regional structure was political camouflage for centralized monetary control. And here's the critical part. The system would be owned by private member banks, not the government. Think about what that means. Member banks would purchase stock in the Federal Reserve. They would earn dividends on that stock 6% annually, guaranteed by law, paid from the profits of controlling the nation's money supply. The Federal Reserve would have the power to set interest rates, expand or contract credit, and create money by purchasing government debt. The incentive structure was extraordinary. Private banks would own the institution that determined how much their business was worth and how much money existed in the economy. They would profit from the very system that was supposed to regulate them. They called it the Aldrich Plan when it was first introduced in 1911. It died immediately in Congress. Americans hadn't forgotten the Bank of the United States or the financial panics that occurred even when central banks existed. More importantly, Aldrich's name was political poison. He was openly viewed as Wall Street's senator, the man who represented banker interests rather than the American people. No progressive Democrat or populist Republican would touch legislation bearing his name. The Jekyll Island plan seemed dead on arrival, but the banking elite adapted. When Democrats captured the House in 1910 and then the presidency in 1912 with Woodrow Wilson, they executed a political rebrand. They stripped Aldrich's name from the bill entirely. They recruited Virginia Congressman Carter Glass, a Democrat, to champion it as a Democratic initiative. They reframed the entire proposal as a check on Wall Street rather than Wall Street's creation. The language changed, the sponsor changed, the political framing changed, but the substance, Frank Vanderlip later wrote in his 1935 autobiography, although the Aldrich Federal Reserve Plan was defeated when it bore the name Aldrich, nevertheless its essential points were all contained in the plan that finally was adopted. The economic promises sounded reasonable, even noble: prevent banking panics, ensure credit availability during crises, protect farmers and small businesses from seasonal credit crunches, stabilize the currency. These weren't lies. The system would do these things. What wasn't advertised was the cost. The permanent transfer of monetary authority from elected government to private banking interests, and the transformation of the US dollar from a store of value into an instrument of credit expansion. The political climate couldn't have been better for the bankers' plan. Wilson's victory in 1912 had been aided by progressive anger at financial concentration, the very concentration the Pujo Committee was exposing in real time. The committee's 1913 report confirmed what reformers suspected. 5 firms, J.P. Morgan, First National Bank, National City Bank, Guarantee Trust, and Bankers Trust, held 341 directorships in 112 corporations with over $22 billion in resources. Louis Brandeis compared this to the value of all property in the 22 states west of the Mississippi River. The public wanted financial reform. They demanded it, and they got a system designed by the people they wanted reformed. December 1913. Congress debates the Federal Reserve Act. The bill's supporters argue it will democratize finance, breaking the power of Wall Street. Senator Nelson Aldrich has retired. His name appears nowhere on the legislation. Most congressmen have no idea that the Jekyll Island meeting even occurred. They believe they're voting on a Democratic solution to Republican banker excess. On December 23, 1913, 2 days before Christmas when many members have already left Washington, President Woodrow Wilson signs the Federal Reserve Act into law. The bill passes the House 321 to 85. The Senate votes 43 to 25. The 6 men who drafted it on Jekyll Island remain anonymous. The Federal Reserve System begins operations in November 1914. The structure is exactly as planned. 12 regional Federal Reserve banks, owned by member banks, a board of governors in Washington, appointed by the president, the power to set reserve requirements, discount rates, and expand credit, the authority to purchase government debt, creating money in the process, a guaranteed 6% dividend to member bank shareholders. World War I begins 9 months later, requiring unprecedented federal spending. The timing was impeccable. When the Federal Reserve opened its doors in November 1914, the US national debt stood at $2.9 billion. The dollar could purchase what would require $32.72 today. Within the system's first 7 years, as World War I demanded massive federal spending, the debt exploded to $24 billion. That's an 827% increase in 7 years. The Fed monetized over $1 billion in Treasury securities during the war alone. The money supply expanded dramatically, and with it came inflation. This wasn't accidental. This was the system working exactly as designed. Here's the mechanism. When the government needs money, it issues Treasury bonds. The Federal Reserve can purchase these bonds by crediting the Treasury's account. Money created from nothing, backed by nothing but the government's promise to repay. This wasn't unique to the Fed. All central banks can do this. What was unique was the incentive structure. Private banks owned the Federal Reserve, earned dividends from its profits, and benefited from an expanding money supply that inflated the value of their assets and increased loan demand. Economic growth wasn't even required. The money supply could expand regardless of actual productivity. But wait, you might ask, wasn't the dollar backed by gold? Didn't that limit money creation? In 1913, dollars were convertible to gold at $20.67 per ounce. In theory, this constrained printing. You couldn't create more dollars than you had gold to back them. But the Fed's design included a critical loophole. The gold reserve ratio could be adjusted, and the Fed could expand credit through fractional reserve banking. By the 1920s, the Fed was creating money at multiples of gold reserves. The link between dollars and gold was already weakening. Then came 1933. President Roosevelt outlawed private gold ownership and revalued the dollar to $35 per ounce, a 41% devaluation overnight. The government confiscated gold from American citizens at the old price and immediately revalued it higher, transferring wealth directly from citizens to the Treasury. The Fed had already disconnected money supply from gold reality. This just made it official. Finally, in 1971, President Nixon ended dollar-gold convertibility entirely. The Bretton Woods system collapsed. The Fed could now expand the money supply without any commodity constraint whatsoever. The numbers don't lie. $1 in 1913 purchasing power equals 3 cents today. That's a 96.9% loss of value. The national debt went from $2.9 billion in 1913 to over $35 trillion today. That's a 12,000 times increase. The M2 money supply, a measure of dollars in circulation, went from 4.6 trillion in 2000 to 19.5 trillion in 2021. A 324% increase in just 21 years. 20% of all dollars ever created were created in 2020 alone. $3.4 trillion in a single year. But this wasn't inflation that hurt everyone equally. Asset holders, those who owned stocks, bonds, real estate, saw their wealth inflate along with the money supply. Wage earners and savers were systematically robbed. Every dollar in your bank account was worth less each year, while those with access to cheap Fed credit, the banks themselves, could borrow newly created money at preferential rates and invest it before the devaluation reached the broader economy. This is the Cantillon effect. Those closest to the money creation get the value. Those furthest from it pay the inflation tax. By the 2008 financial crisis, the Fed's balance sheet held under $1 trillion in assets. Then came quantitative easing. The Fed's balance sheet exploded to $4.5 trillion by 2015, then to $9 trillion by 2022. Each dollar created diluted every dollar already in existence. The system created on Jekyll Island had become exactly what Americans feared in 1913. You're living in the economy those 6 men designed. Every financial anxiety you feel, the sense that you're working harder but getting poorer, that housing is unaffordable, that retirement is slipping away, is a feature, not a bug. Your salary increases, but your purchasing power declines. You save money, but inflation eats it faster than interest can grow it. You're told this is normal, natural, necessary for economic growth. It's not. It's the direct result of a monetary system designed to transfer wealth from those who work for money to those who create it. Inflation is often called a hidden tax, but that's too gentle. It's systematic theft. The Federal Reserve doesn't need Congress to approve its money creation. It doesn't need voters to consent. It creates dollars, and every dollar it creates makes yours worth less. Who benefits? The government can spend without raising politically unpopular taxes. Banks can lend money that didn't exist yesterday. Asset holders see their portfolio values inflate. The stock market hits records even as real wages stagnate. This isn't economic growth. It's monetary expansion masquerading as prosperity. The Federal Reserve is technically independent. It doesn't answer to the president, and Congress has limited oversight. Its meetings are private. Its decisions affect every American, yet Americans don't vote on them. The Board of Governors is appointed, not elected, and remember, member banks own the Federal Reserve banks and earn guaranteed dividends. In 2022, while inflation hit 40-year highs and ordinary Americans saw their savings devastated, the Federal Reserve paid out over $23 billion in interest to banks. The system protects its owners first. What if the panic of 1907 had been solved differently? What if, instead of creating a central bank owned by private institutions, America had established a true public monetary authority, one that created money for public benefit, not bank dividends? What if the dollar had remained tied to a finite commodity, preventing unlimited expansion? We'll never know. The Jekyll Island 6 made sure we couldn't choose that path. By crafting their plan in secret and hiding their authorship, they eliminated the possibility of informed democratic debate about the century's most consequential economic decision. Since 1913, the Federal Reserve has presided over the Great Depression, where its monetary contraction turned a recession into catastrophe. Stagflation in the 1970s, where double-digit inflation combined with economic stagnation. The dot-com bubble in 2000, where easy money inflated tech stocks to absurd valuations. The housing bubble in 2008, where Fed-enabled lending created the subprime mortgage crisis. The inflation crisis from 2021 to 2023, where COVID-era money printing drove inflation to 40-year highs. Each crisis followed the same pattern. Easy money creates bubble. Bubble pops. Fed creates more money to fix crisis. New bubble forms. The system doesn't fail. It operates exactly as designed. Crisis and bailout are 2 phases of the same wealth extraction mechanism. Understanding this history doesn't require despair. It requires action. First, recognize that dollar depreciation is policy, not accident. Second, protect yourself by holding assets that maintain value despite currency debasement. Hard assets, productive investments, skills that compound. Third, Demand monetary accountability. The Federal Reserve operates in shadow by design. Sunlight is the best disinfectant. Fourth, understand that financial literacy is self-defense in a system designed to confuse and extract. In November 1910, 6 men met in secret and designed a system that would quietly transfer wealth from workers to bankers for over a century. They succeeded because Americans didn't know who created the plan or why. Now you do. The question isn't whether the Federal Reserve has enslaved America through monetary manipulation. The 96% dollar devaluation and $35 trillion debt answer that. The question is, what are you going to do with this knowledge?